If you have spent any time consuming financial content online, you have almost certainly been told some version of the same advice. Open an index fund. Contribute to your 401k. Buy and hold for the long term. Diversify across asset classes. Stay the course when markets get volatile. This advice is not wrong. For most people in most circumstances, it is genuinely sound guidance that will produce better outcomes than the majority of alternatives. But here is what that advice leaves out entirely. The people with the most money in the world are not following it. Not primarily. The investment playbook used by individuals with $50 million or more in investable assets looks fundamentally different from what gets taught in personal finance content recommended by mainstream financial advisors and discussed in the financial media that most people consume. And the gap between those two playbooks is not a matter of opinion or preference, it is a matter of access. Access to asset classes, structures, and opportunities that have historically been legally restricted to a small portion of the population. That is beginning to change. And understanding what the ultra-wealthy actually own and why they own it is the starting point for making smarter decisions with whatever you have to invest right now. In 2023, a comprehensive study analyzed the actual portfolio compositions of ultra-high net worth individuals defined as people with more than $30 million in investable assets. The findings surprised a lot of people in the financial media who covered the story, though they surprised almost nobody who actually works inside wealth management at that level. Less than 30% of these portfolios were in publicly traded stocks and bonds. Less than 30%. The asset class that dominates the conversation in personal finance content, the one that gets the most attention, the most analysis, and the most advice, represents less than a third of how the wealthiest investors in the world actually allocate their capital. The remaining 70% was spread across what the investment industry groups together under the label of alternative investments. Private equity, private credit, real assets including real estate, farmland, timberland, and infrastructure. Hedge funds using strategies unavailable in public markets. Direct ownership stakes in private businesses. Collectibles and other hard assets. These are the categories that dominate the portfolios of the genuinely wealthy. And they dominate those portfolios for specific, evidence-based reasons that have nothing to do with exclusivity or prestige. The first reason is what institutional investors call the illiquidity premium. When you invest your money in something that trades on a public exchange, like a stock or a bond, you retain the ability to sell that investment at any moment during market hours. This liquidity is genuinely valuable. You can access your money when you need it, rebalance when circumstances change, and exit positions when your view of the investment changes. But that liquidity comes at a cost. Because every other investor also has that same liquidity, public markets are extraordinarily efficient at pricing assets. The information available to you is available to millions of other participants simultaneously. The opportunities to buy something meaningfully below its fair value are rare and fleeting. Private investments do not have this liquidity. When you commit capital to a private equity fund, a private real estate investment, or a direct business stake, you are typically committing it for 5 to 10 years with limited ability to exit early. You're accepting a real constraint on your financial flexibility. The market compensates investors for accepting that constraint. Historically, private investments have generated returns approximately 2 to 4% higher annually than comparable public market investments. This premium exists precisely because most investors are not willing or able to accept the illiquidity. The ones who can accept it get paid for doing so. 2 to 4% sounds modest. Compounded over 30 years on a meaningful investment, it is not modest at all. The difference between an 8% average annual return and a 10% average annual return on $1 million invested over 30 years is approximately $4 million of additional wealth at the end of that period. Not from taking more risk in the conventional sense, from accepting a different kind of constraint that the market pays you to accept. The second reason the ultra-wealthy allocate heavily to alternatives is non-correlation. This is a concept that sounds technical, but is actually straightforward once you understand what it means in practice. When the public stock market experiences a significant decline, as it does periodically and unpredictably, virtually every publicly traded asset tends to decline with it. Stocks fall. Bonds sometimes fall. REITs fall. International stocks fall. The correlations between public asset classes, which may appear low or even negative during normal market conditions, tend to converge toward one during periods of genuine market stress. Everything falls together at exactly the moment you most want something in your portfolio that is not falling. Private assets behave differently. The value of a farmland investment does not move because the S&P 500 had a bad week. The rental income from a properly managed real estate investment does not stop because public market investors are panicking. The performance of a private credit fund is tied to the creditworthiness of its borrowers, not to the sentiment of public market participants. These assets are non-correlated with public markets not because they are inherently safer, but because their value is determined by different factors entirely. A portfolio that combines public market investments with genuinely non-correlated private investments does not just potentially earn higher returns. It also experiences less dramatic swings in total value during market dislocations. The wealthy are not just chasing higher returns with their alternative allocations. They are building portfolios that hold their value better when everything else is falling apart. The third reason is access to opportunities that simply do not exist in public markets. The most attractive investment opportunities in the world, the companies with the highest growth trajectories, the real assets with the most favorable supply and demand dynamics, the credit opportunities with the best risk-adjusted returns, almost never make it to public markets in their most attractive form. By the time a company goes public, the majority of its most dramatic value creation has already occurred. The investors who captured that value creation were private investors who had access to the company before it went public. For most of the history of modern finance, this access was legally restricted. The Securities and Exchange Commission's definition of an accredited investor, the category of person permitted to invest in private offerings, required either annual income above $200,000 or a net worth above $1 million, excluding the primary residence. The minimum investment sizes that private funds would accept range from $250,000 to $1 million per commitment. The knowledge of which funds were open, performing well, and worth accessing required relationships that took years to build within professional financial networks. The system, whether by design or by consequence, kept the returns from alternative investments concentrated among the people who already had the most wealth. Something meaningful has begun to shift in recent years. A new generation of investment platforms has emerged with the explicit goal of lowering the barriers to alternative investment access for a broader range of investors. Fundrise, one of the most established of these platforms, allows investors who are not accredited to access private real estate funds with minimum investments starting at $10. The underlying assets are the same types of private real estate investments that institutional investors have accessed for decades. The structure is different, designed to accommodate smaller investors, but the asset class is identical. Masterworks is a platform that allows investors to purchase fractional ownership in individual works of blue-chip contemporary art. Art, as an asset class, has historically generated average annual returns in the range of 13 to 14%, with correlation to the stock market that is extremely low. The minimum investment on Masterworks is in the range of a few hundred to a few $1,000s, depending on the offering, compared to the millions required to buy a significant artwork outright. Platforms like Alto allow investors to hold alternative assets, including private equity, private credit, and cryptocurrency, inside a self-directed IRA structure. This means the returns from alternative investments can compound inside a tax-advantaged account, which significantly improves the after-tax outcome over long holding periods. These platforms are not perfect replicas of what the wealthiest investors access. The fees are sometimes higher. The specific opportunities are more limited. The due diligence burden on the individual investor is greater because the regulatory guardrails are different. Anyone considering these platforms needs to understand the liquidity terms, the fee structure, the track record of the underlying assets, and their own time horizon before committing any capital. but they represent a genuine and meaningful shift in what is possible for investors who are not members of the ultra high net worth category. The asset classes that have historically driven superior returns for the wealthiest investors are becoming accessible to a much broader group. The question is whether that broader group will take the time to understand what they are accessing before they do. Here's the practical framework for thinking about alternatives in your own portfolio. Alternative investments are not a replacement for a foundation of low-cost, diversified public market investments. They are a complement to that foundation. Most institutional investors and the advisors who work with high net worth individuals recommend limiting alternative allocations to somewhere between 10 and 20% of a total portfolio until the investor has a clear understanding of what they own, why they own it, and what the realistic exit scenarios are. Before committing to any alternative investment platform or opportunity, there are 4 questions that need clear answers. First, what are the liquidity terms and what happens if you need your money before the expected exit? Second, what is the complete fee structure, including management fees, performance fees, and any platform fees? Third, what is the actual track record of the underlying assets, not just the platform's marketing materials? Fourth, what is your realistic time horizon, and are you genuinely prepared to leave this capital committed for the expected duration? The ultra-wealthy do not invest differently because they were born knowing something that everyone else does not. They invest differently because they had access to asset classes, structures, and professional guidance that were not available to most people. That access is changing. Slowly, imperfectly, but genuinely. The question is whether you will take the time to understand what is now available before the opportunity becomes as crowded and efficient as the public markets that most investors never move beyond. Next week on Quiet Rich, I'm covering the fee structure buried inside most American retirement accounts and the specific numbers that explain why millions of people will retire with significantly less than they should have despite doing everything their financial advisor told them to do. Subscribe so you do not miss it. New videos every Tuesday and Friday.